All right, let's talk about what's on every investor's mind right now. A massive conflict has just erupted in the Middle East, and it's completely shaken up the global markets. I mean, what was once just a distant possibility is now staring us all in the face, and it's got everyone asking the same thing. What on earth happens next? It's kind of wild to think about, but just a few weeks ago, a huge war in the Middle East was what you'd call a fringe risk. It was that thing tucked away in the back of financial models, in the column labeled, yeah, probably not going to happen. And then, bam, in a flash, everything changed. That fringe risk is now the number one worry for investors all over the world. It's casting this huge shadow of uncertainty over, well, everything. We're talking global trade, the price of gas, and that ongoing battle against inflation. So, what was the spark that lit this fire? Well, it was a huge, dramatic event, a series of U.S.-Israeli strikes that reportedly killed Iran's supreme leader. And the fallout was immediate and chaotic. Iran firing back at Gulf cities, airlines grounding all their planes, and those giant, crucial oil tankers just stopping dead in their tracks at the Strait of Hormuz. Just like that, the entire game board was flipped upside down. Okay, now this is where it gets really interesting. Take a look at this chart. It shows us that investors were already getting pretty nervous before this whole thing blew up. You can see it right there. Gold is up 22% this year. Brent crude oil is up 20%. But the S&P 500? Almost totally flat. What does that tell you? It tells you that money was already quietly moving into those classic safe havens. People were hedging their bets against something. They just had no idea it was going to be this. So, this brings us to the first big argument you're hearing everywhere right now. Let's call it the case for crisis. This is the camp that says, hey, this is not just another headline you can scroll past. They believe this is a genuine game changer for the entire global economy. And this quote from Wrong Go over at Eastspring Investments, it just nails this point. He says, markets are going to reprice from a geopolitical shock to a regime risk shock. He's talking about a prolonged conflict, not just a simple tit-for-tat retaliation. Now hang on to that phrase, regime risk shock, because it's super important. So what in the world is a regime risk shock? Well, put simply, it's the fear that this isn't just some contained temporary fight that'll be over in a few weeks. No, it's the anxiety that this conflict could actually lead to the collapse, or at least a total overhaul, of a country's entire government. And that doesn't mean a quick fix. It means long-term, messy, unpredictable instability. And here's how that instability hits the real world. According to Capital Economics, if this conflict drags on and messes with the oil supply, we could easily see prices jump to $100 a barrel. Yeah, $100. So, okay, $100 barrel of oil, what does that actually mean for you and me? Well, a surge like that could tack on an extra 0.7 percentage points to global inflation. That would basically wipe out a ton of the hard work central banks have been doing, and it would hit all of us right where it hurts, in our wallets. All right, but there's always another side to the story, right? Let's flip the coin and look at what some are calling the argument for complacency. This is the school of thought that says, look, history shows us that markets always overreact to stuff like this. The argument here is that the smart move is to just take a deep breath and wait for the panic to die down. And the analysts at Barclays put it pretty bluntly. They say, and I quote, history argues strongly in favor of selling geopolitical risk premium when hostilities start. What does that mean in plain English? It means that historically, you make money by betting against the panic. You sell when everyone else is scared, assuming things will, eventually get back to normal. And then you've got Ed Yardani from Yardani Research, who gets even more specific. He basically says, we wouldn't be surprised if the S&P 500 sells off on Monday morning and then turns right around into a rally. I mean, that is the classic buy the dip strategy in a nutshell. He's suggesting that the initial wave of fear could actually be the perfect buying opportunity. So here you have it, two completely opposite pieces of advice on what to do with your stocks. You've got the pessimists over at Barclays saying, whoa, hold on, don't buy that dip just yet. And they're warning we could see a drop of over 10%. But then you have the optimists like Yardani saying that morning sell-off is the exact time to get in because a fast recovery is on the way. It's a total Wall Street standoff. Okay, so we have these two powerful, conflicting stories. The big question is, how is this all playing out in the real world across different kinds of investments? Where is the money actually flowing? Let's dig in and break it down.
This table really lays out the tug-of-war perfectly. Let's start with U.S. Treasury bonds. Normally, they're the ultimate safe place to put your money. But the pessimists are worried that a spike in oil will cause inflation, which is bad for bonds. The optimists, they think that classic flight to safety demand will win out. Then there's gold. Some analysts think all the fear is already baked into the price, while others think it could still tick up a bit more. And then, of course, oil. This is the heart of the whole debate. Is it going to rocket to $100 and fuel inflation, or will the whole thing be contained with prices falling once the dust settles? As you can see, analysts are completely split right down the middle.
And really, this all boils down to one central question that every single investor is wrestling with right now. Do you trust history? Do you believe the historical patterns that tell us these crises are just temporary bumps in the road, maybe even great buying opportunities? Or is this time different? Is this something totally new, a kind of risk that makes all the old playbooks totally useless? And here's a fascinating twist. The same Barclays analysts who talked about history also have a warning. They say the biggest danger might not even be the conflict itself. The real fear, it's us. It's investor complacency. Their worry is that we've all been trained like Pavlov's dogs to just buy the dip every time something bad happens. And because of that, the market could be seriously underestimating the chances that this time containment fails and things really, truly spiral out of control. So that leaves us with this one final, incredibly important question. For decades, the entire investment world has operated on one core assumption, that at the end of the day, these big geopolitical flare-ups will be contained. But what happens when that core assumption gets tested? What happens if containment fails? Is history still a reliable guide then? That right there is the billion-dollar or maybe trillion-dollar question hanging over absolutely everything right now.